Hello guys. So I'll be doing the 2021 paper. So okay, I'm gonna start. So it starts with question one. Says ignore VAT. So we'll ignore VAT, but taxes will still be there. So they still defer tax. If they said ignore taxes, then it meant that like you must also ignore deferred tax. And then let's start. You're a recently qualified CA. Have joined IFRA's advisors as a consultant. Your first assignment is to assist with the consolidation of Mohale Music Limited and its subsidiaries. This is your first year on the engagement, and the partner has provided some information to give you an understanding of the entity. Refer to the appendices below. Then it says additional information. Mohale Music and its subsidiaries have a 28 February financial year. So which means the financial year it begins um the financial year starts on the 1st of March. The 1st of March to the 28th of February. Yeah, of Feb. And then Mohale Music and its subsidiaries apply IFRS in its preparation of its financial statements. The accounting policies have been aligned between all entities. So this just means that the entities use the same accounting policies. And then non-controlling interest is measured at its proportionate share of net assets at the date of acquisition. So it's not at the fair value. It's measured at the net proportionate share. So not the fair value. Okay. Yeah. So fair value of net proportional share. And then in the separate financial statements of Mohale Limited investments are carried at cost. Okay. So we already know this one. And then IS 16, property, plant and equipment, land, manufacturing equipment and delivery vehicles are accounted for in the cost model. Okay, then manufacturing equipment and delivery vehicles have a useful life of 10 years and 5 years respectively. And then um, they tell us, or okay, they tell us that intangible assets are accounted for in the cost model according to IS 28. Brand names have an indefinite useful life, and research capitalized in business combination has a finite useful life of 10 years. And then tax, okay, SARS doesn't grant allowances on intangible assets, okay. We must assume that all amounts calculated by Mohale Group are correct, right? Can move on. And then it says in Mohale Limited, encouraged by the company's success and recognizing the need for quality music. So okay, here they are just introducing the company. So this is more appropriate for finance. So I'll move on to the next one, Kruger Motors. So as part of the diversification strategy, on 1 March 2015, so that's a very important date. That's the acquisition date. Mohale Music acquired a 75 controlling interest in the 100-year-old Kruger Motor. Under Mohale's new vision, the Leopard delivery vehicle was released and soon became a world phenomenon, used for delivering everything from eggs to highly sensitive medical equipment. Okay, can continue. Okay, breaking news. Okay, um, forced by forced by computer chip shortage, Kruger Motors buys a 51 stake in intelligence. Okay, so in this question, you'll see it is a complex group. We haven't done complex groups before. Because I didn't see them like really do them there, but I will just go through the basics of like complex groups. They are not really that hard. So let's say you are the parent, ne, and then you have like subsidiaries like this. So one subsidiary here, and then one subsidiary here, right? So basically, the parent buys a stake in this company and this company. So what you're gonna do is when you're consolidating, you're gonna treat this company basically separately. You're gonna do the analysis of equity of this one, and then account for it as if it's the only subsidiary, and then do also for this one and account for it as if it's the only subsidiary. So in that case, it's easy. So if they ask you a question relating to this, like business, you'll do normal groups. If they ask you a question relating to this, you'll do normal groups. If they ask you to consolidate, you have to do groups for this one first, and then also for this one. Yeah. And then, but that one, they don't like that type of complex group because, like I said, it's the same. And then the next one is something like this. So you have the parent here, and then the subsidiary. So the parent owns the subsidiary, and then the subsidiary bought another company which it owns. So the subsidiary bought another like sub-subsidiary it owns, right? So in this case, the parent, which is Mohale, bought Kruger, right? And then Kruger bought intelligence. So still, by virtue of what do you call this? By virtue of the parent controlling the subsidiary, the parent also controls the sub-subsidiary. You see? So what does it mean? It means that you're gonna do the analysis of equity of this company, and then what you're gonna do is the profit that's attributable to like I get when you do the analysis of equity, it will be that 51% and then 49 the side, right? That profit attributable to the parent. So in this case, this is the profit under 51% will be the profit attributable to the parent, right? And the parent in this case is the subsidiary, right? So you are gonna put a portion of the profits from the sub-subsidiary in the parent's analysis of equity because that's part of what the parent is getting, right? So the parent, what do you mean? I mean the subsidiary is getting its own profits and the profits from the sub-subsidiary. And then you're gonna do normal analysis of equity from here on, apportion that its profit. But you'll see when you do a question. Okay. And then okay, buys everyone's stake in intelligence, and then in an attempt to secure its supply of vital semiconductor chips for its vehicle production. Okay, following a global pandemic caused by COVID-19 virus, a global shortage of semiconductor chips has hindered the production of motor vehicles, amongst others. Kruger was amongst the major car manufacturers that had to cut down production because of shortage. The shortage sent prices of both. Okay, okay. So in this question, in this one, okay, let's read further. Okay, Kruger obtained the control of intelligence. This is the acquisition date, and then in the record-breaking deal for a Krugersdorp enterprise, Krugersdorp paid that upfront. So there's the consideration, an additional 5 million in 3 years. The previous in 3 years. So what is this? This is a deferred consideration, and then the previous owners will receive another 5 million in 5 years' time if certain performance targets are met. So that's a contingent consideration. These remain highly confident, but insider told um, the Post that one such condition is that the gross profit margin of the tray is maintained. Okay, so we can move on. I assume you already read the scenario, ne, guys. So I'm just gonna go to like the important parts. So mm, as you can see, I think I can start with the question. I just wanted to um, read that first part. However, here this is like mainly technical information. We have to already have a question when we're doing this. Okay, so let me go to the required. Okay, so the required says calculate the amount of goodwill that arose. Yeah, calculate the amount of goodwill that arose from the acquisition of Intelligence Limited, right? So goodwill. With this one, I don't expect you guys to be having like that much of a problem with goodwill. Um, because like I said, before we go to goodwill, we have to firstly do that first step, right? Which is the equity acquisition step, right? So at firstly, we're gonna look for fair value adjustments, right? So let's look at intelligence, right? So fair value adjustments, right? So let's look at information on intelligence. Okay, so here is it. So it says, as mentioned, I assisted in the determination of net asset, identifiable assets and liabilities for intelligence transaction at the acquisition date of intelligence. The net assets of 3.5 million were fairly valued with the exception of manufacturing equipment, which was undervalued by 250,000, right? So here's the fair value adjustment. So this is the one that was undervalued, right? So if the equipment is undervalued, we have to say what equipment, right? So debit equipment, um, what is this? Yeah. So we have to debit equipment, right? And then don't forget the deferred tax. Yeah. And like I said, do like the equity acquisition, do it separately from, yeah, do the equity acquisition separately from like the analysis of equity because it's gonna be confusing. Yeah. And then let's look at the rest. So it says we identified intelligence had a brand name as an identifiable intangible asset that is separable, right? So let's go here. So we are done with the fair value adjustment. So now we are going to the additional items. So let me just go through the additional items with you. Yeah, the additional items there. So let's go to them. So the first one is contingent liability. Right. So when do you include a contingent liability? Like I said, if there's a present obligation, right, and the fair value can be reliably, I mean, yeah. And then that's basically for contingent liabilities. If that's the case, you are gonna include that contingent liability as a liability at acquisition. And then assets held for sale, you don't use its fair value. It's equal to the fair value less cost to sell, not lower of. Right, and then deferred tax will still be measured according to IS 12 if you have a deferred tax balance, not the fair value. And then employee benefits, right? You're gonna measure it in accordance to IS 19, not fair value. So like you're not gonna do like the fair value adjustments. And then for intangible assets, it has to basically let's go here. For intangible asset, it has to be identifiable, right? That's the first thing. It has to be identifiable, right? And it must also be it can be reliably measured. So identifiable, what does it mean? It means that separable, right? Or there's a contract, or like it arises from a contract or a legal obligation. So let's look at this one, right? The one that you've been doing. So it says the brand name. We identified the brand name as an identifiable intangible asset that is separable. Do you see separable? So which means it is separable and it can be reliably measured. That's why it was included, right? That's why it was included. Yeah, it met those two conditions. And then we go to the next one. We have identified in process research costs, right? That is also separable. So the research costs are also separable. So they're intangible assets and it can be reliably measured. That's why they were included in equity acquisition. So this is all of this is equity acquisition. Don't forget the deferred tax for each of them. And then after we are done with equity acquisition, now we go to the mean elimination journal entry, right? And like we said, with mean elimination, what do you do? You're gonna firstly debit. You see the question said calculate, right? So you could have used journal entries or you could use the analysis of equity. So yeah, you could have used the journal entries or analysis of equity. I like to use both. One. So in terms of the journal entries, at acquisition, you're gonna have basically the equity acquisition of the so equity acquisition of the what do you call this? The yeah, equity acquisition of the subsidiary, right, which is this 37 thousand 500 37 million 500, right? And then after you're gonna say you're gonna debit the equity at acquisition, right, that amount. But don't forget that you are debiting what? The fair value of the equity of the sub, right? So you're gonna have to debit firstly that amount that was in the statement, and then also remove equity acquisition. That's what they did here, right? That's the first thing you do, debit it, right? And then basically it's gonna be this amount. And then what are you supposed to credit? The investment, right? Investment in subsidiary. So you must look at how your investment in subsidiary was calculated. How was it calculated? It was calculated using the consideration, right? That Intel received. So let's look at the consideration that Intel received. Okay, here's the consideration. It says they received 50 million upfront, right? And then that's the first thing. So that's where this 5 million comes from. And then obviously, like I said, this one is a deferred consideration, and the other one is the contingent consideration. And you have to include the deferred consideration. You have to consider time value effect. So it has to be at both of them have to be at its fair values. So let's look at the fair values of those things. Fair values. Okay, so here are the fair values. So the contingent consideration, here's the fair value, not the present value, the fair value. And then the deferred consideration, here's the fair value. But for deferred consideration, the fair value could also be the present value because it's basically just taking the time value of money into account. And then, okay. And then after that's investment basically in subsidiary, then you want to get your NCI. So you're gonna credit with NCI. So here's your NCI, right? Um, yeah, here's your NCI. And then what happens is you wanna calculate now your goodwill, right? So this is what you debited, like first, right? This amount. And then what did you do? You credited this amount, right? So you debited this amount. Yeah, you debited this amount and then you credited this amount, right? Yeah, you credited this amount. And then you also credited the amount of the non-controlling interest, right? And then the balancing figure, which is a debit balance, is the goodwill. Yeah. Okay. Let's move on to the next question. Okay. So B says discuss the recognition and measurement of land that was sold by Kruger Motors to Mohale Music, both in Kruger Motors individual and Mohale Music's consolidated financial statement. So it wants both individual and consolidated. So both separate and consolidated, right? And then um, so let's look at the response, right? So let's look at this. It says what? Yeah, Kruger. Let me just remove this, okay? Change prior to changing intention to use the sale of the land, Kruger will recognize the land as PPE and on it, yeah, measure it on the cost model, right? That is prior to the change. Then on 15 February, when Vele they had the intention, they're gonna classify it as non-current asset held for sale because they still have that asset. Then on this date, the non-current asset held for sale was measured at 3 million, which is lower than its fair value less cost to sell, so there will be no impairment, right? So this is just normal IFRS 5. And then during 29 February, so you have to remeasure it. You see that the fair value less cost to sell is less than the carrying amount. Therefore, there have to be an impairment of 250 through profit or loss, right? Then from the group perspective, like I said, group perspective, we did like an example like this. We did something similar to this because what this thing is still property, plant, and equipment. Why? Yeah. We did do this, but I think it was only with PU. So basically, the land is still classified as property, plant, and equipment. Why? Because the intention is still to use it by the group. You understand? So the group's intention hasn't changed in terms of like using this asset. It's only the intention from like a separate level. However, the group itself does not plan on selling this thing. It plans on using it, just not using it like under the capacity of like the other entity. It wants to use it under the capacity of Mohale, not Kruger. And then the group's accounting policies will measure land according to the cost model. So the original cost is there. Therefore, there must be an impairment reversal of 250 thousand. So you can also see this thing when you do those general entries that you normally do for groups. So when you do separate for both, combine them and then do a group journal entry to get the pro forma, right? You still get this basically. And then, sorry, we can basically move on to the next one. Okay, so the next question asked us to refer only to the assets in Appendix F, extract from fixed asset register, calculate the following amounts as they would be presented in Mohale's consolidated financial statement. So firstly, the depreciation expense, right? So let's go look at these assets. What are these assets they're talking about? So, okay. Okay, so here's the fixed asset register, right? So this asset is in Mohale's books. So it's land, right? So we all know for land, there's no depreciation for land. So you won't calculate any depreciation for the land, right? Even like it doesn't matter from a group perspective, separate, there's no depreciation for land. So that's why for depreciation, it's zero, right? Then we go to the next one, which is delivery vehicles, Kruger Leopard, right? So let's look at the delivery vehicles. So as you can see here, they said purchase price is at 300,000, residual value is there 10K. So that's in Mohale's books, right? That's in Mohale's books. But we also told here on 1 March 2020, which is at the beginning of this year, Mohale Music purchased the delivery vehicle from Kruger, right? So this is a intergroup transaction, right? And Kruger produces it at the cost of that. However, when you look at the fixed asset register, I guess this fixed asset register is from, they told us, so it's from Mohale Music, do you see? So which means this 300,000 is the basically the actual price that like Kruger charged Mohale, but the cost was 270,000, right? So now let's look at basically the depreciation. You see, when you are doing like for this one, like they say consolidated, just you can look at it like only like from a group perspective, you can still get your answer. So what do I mean? I mean we have I get this diagram that we normally use, right? So we have the subsidiary here, we have the parent, right? And then the subsidiary sells the vehicle to the parent for 300,000, right? Sells the vehicle for 300,000 to the parent. However, it acquired the vehicle at a cost of 270,000, right? Okay. Now, from a group perspective, like I said, the parent and the subsidiary basically they disappear, right? So what happened in the group perspective? They bought this basically they manufactured this thing at this cost, right? And then they started using it during the year, right? So we have to understand that from a group perspective, they are using this thing at this value, right? It has to be at this value, right? So the only thing that's left is just seeing the depreciation rate, right? So we know for delivery vehicles, like they told us on top, they said it's 5 years, right? So you're gonna see 270,000 minus the result value, which is 50,000, right? And then divide by 4, right? And then after that, you should get 44,000. Yeah, let me just check. You should get 44,000, which will be the group's depreciation, right? It's not divided by 4, I mean divided by 5. Yeah. Okay. Yeah, so it's 44,000 and then so that explains this 44,000. So this is the method that they used. But I normally use, like I said, the group method. That's where this 44,000 comes from. we can go to the next part, which is manufacturing equipment, right? So yeah, it's this manufacturing equipment, right? So what did they tell us about it? They tell us that with the exception of the manufacturing equipment, which was undervalued. So at acquisition at acquisition date, right? At acquisition date, Intel had manufacturing equipment, right? That it purchased, right? Basically, it purchased before the acquisition date, right? Because we acquired intelligence on the 1st of January 2021. So it was 10 months basically after they used this equipment, right? And then they told us that it was undervalued. So what should you do? You should calculate the carrying amount at acquisition, right? And then after calculating the carrying amount at acquisition, what is that? The carrying amount at acquisition, yeah, after calculating the carrying amount at acquisition, you have to increase the carrying amount at acquisition with this amount, 250, the amount that it was undervalued by. Now you have the value of the land, right? Now you have the value of the land at acquisition date, right? So with that value of the land, um, so let's just come here. Let me show you what I mean. So we want firstly the carrying amount at acquisition date, right? So the carrying amount at acquisition date is what? This is the depreciation, the full depreciation for the year. So it's gonna be 7.5 million, right? Yeah, 7.5 million minus the depreciation for 10 months, right? So multiplied by 10 over 12, right? So it's going to be, yeah, in global 6, 8, 9, 5, 8, 3, 3, right? Right. And then you're gonna add the 250 here, add the 250 because it's at acquisition, right? It was undervalued. And then the answer here is, okay, so 7145, yeah. And then what's the depreciation rate of this? So you're gonna divide the answer by 10, the depreciation rate, yeah, with the depreciation rate. And then let me just double check, yeah. Divide it with 10, so divide it with 10, 10 years depreciation rate. And then that's per year, right, that you have. However, this was for only 2 months, so divided by 12 times 2. Yeah, yeah. Mm, okay, so I was looking at like why I didn't get the same answer I got. So, mm, okay, so okay, so like in this question, like they honestly like took an approach that Like you can take this approach, or you can take the approach that I showed you, even though they don't give you like the same answers, because it's a matter like of explaining it. Because this one that they are using like does, like, fundamentally does not make sense. Because why do I say like fundamentally does not make sense? Because okay, let's just come here. I'm sorry guys that I made a mistake. The way they did it here is correct. So in terms of like this one, so in terms of this one, like you must do it like in isolation. So you must look at like the depreciation. That's gonna be like the depreciation when this thing was part of the group. I guess they acquired this thing, they acquired this business 2 months before year end. So you have to include the depreciation for that period. And then obviously because it was undervalued, you must increase the depreciation to the point of like it being the same value, right? Hence they use 250 here divided by 10 times that. You see, they only use 2 months for depreciation. I hope you got it there. And then, so that's for the depreciation part of the question. Now we can move on. The next one, it says calculate the carrying amount of each of the assets, right? So with land, there was no depreciation. Therefore, the carrying amount remained 3 million, right? And then for delivery vehicles, we did calculate the depreciation and the carrying amount is this, right? And then we go to manufacturing equipment. Same thing. Here's the total cost. Here's the total depreciation, and then here's the carrying amount, and here are the total assets. Right. Let's look at the next question. It says calculate the deferred tax asset or liability balance. Right. So because they're asking you to do the assets and liabilities, so you use the assets and liabilities method. Right. So the assets and liabilities method, you start with the carrying amount of accounting, right? So you take the delivery vehicles carrying amount, and then for the tax base, I get when Mohale Music bought it bought the car for 300,000, right? So with that 300,000, um, it's going to say 300,000, and the tax base is 4 years, right? Yeah. So if you remove one of those years, you get 225,000. Temporary difference of 1,000, and then you multiply it with the rate to get your deferred tax, right? Yeah. And then, so that's basically C, right? And then we'll go to D. So D, it says prepare all pro forma journal entries, including the taxation required to account for for the intragroup transaction of the sale of the semiconductors, right? So let's go to that sale of the semiconductors, sale of the semi. Okay, here the semiconductor chips, right? Yeah. So they want us to do the pro forma journal entries. So we've got group here, we've got subsidiary, we've got the parent. So basically, it's a transaction between the subsidiary and the parent, right? And then what happened here? The subsidiary sold to the parent, right? How much? Sold 10,000 chips. So it sold 10,000 chips, right? Each at 6,500 each, right? And then, however, the subsidiary got these chips like somewhere, right? From the external market, right? And then what happened? So the parent basically used 5,500 chips, right? In producing their delivery vehicles, right? So let's look at the journal entries from the separate. first. So from the separate of the sub-subsidiary, what are we gonna have? So from the separate of the sub-subsidiary, we are going to have firstly a debit, right? Let me just do this. We're gonna firstly have a debit of bank 65 million, right? And then you're gonna have a credit, right, of revenue, credit of revenue 65 million, right? And then you're gonna have cost of sales, right? And that cost of sales, how are you gonna calculate it? So let's see what they said here. So let's see what they said here. They said intelligence applied its normal gross profit margin, right? So they did tell us the gross profit margin on top, which is 33%, right? So if it's 33%, what does it mean? It means that sales, if sales is 100 and cost of sales is 67, then gross profit is gonna be 33. Yeah. So how do we get the cost of sales for this amount? This is the sales amount, right? So you're gonna say 65 million, which is what you want. So 65 million, I mean, multiplied by what do you want? We want the cost, right? And the cost is what? The cost is 67%. So what is 67? I mean, so you're gonna say multiplied by 67, then divided by what? What do we have? The sales. So what we want divided by what we have. So divided by 100. So we get 43 550, right? And then we credit inventory, the same amount. Yeah. And then that's for the sub-subsidiary. So now we go to the parent. So for the parent, it's going to be mm, okay. So debit firstly, inventory 65 million, credit bank 65 million, debit cost of sales. Okay, so with regards to the cost of sales for the parent, I get we said it sold basically 5,500, right? So that 65 million represents 10,000, right? So we're gonna say divided by 10,000. So that represents 10,000. So for one chip is 6,500, right? Like they told us. Then so 6,500 times 5,500, that gives us 37, 35, I mean 35, 750. Yeah. And then we've got inventory of 35.75. Yeah. Yeah. So that's what's in the separate. And then let's create the combined. So with these separates, let's create the combined, right? So the combined starts with what? So the combined is gonna start with debit cost of sales 7,9,300, and then credit inventory inventory 14,100,000, and then credit banking with 65 million. No, not bank revenue, I mean. Yeah, revenue is 65 million, right? So this is the combined, right? And then, so how did you get the combined this one? So firstly, bank we debited here, and then we credited here. So bank cancels out. So the banks will cancel out. And then revenue, we credited here 65,000. There is no other revenue. So that's why the revenue remains 65,000. And then cost of sales, we debited here. We also debited cost of sales here. So that's why we added the cost of sales and got this amount. And inventory here, we credited. Here we debited. Here we credited. So credit plus credit minus debit, we have like a credit balance of this much. So this is the combined one, right? And then now we can move on to the group level one. Let me just throw this back. So now we can go to group level, right? So in terms of group level, the general entry for group level is with cost of sales, and then credit, inventory. Yeah, inventory. Yeah, 23, 500. Okay, so that's the group level. Why is this the group level? Because at the group level, what happened? The parent used 550. I mean, 5,500, right? There was no sale, but the parent used 515 in its production, right? So if it used that much, right, how are we gonna get that amount? This two three um 9. How did we get that amount? So basically, we have to look at the cost of sales, right? So the cost of sales, like, was the cost of sales then was for 43,550,000, then divided that by 10,000, then you get 4,355. So that's the cost of one chip, and then multiplied by 550,000, then it gives us the 23,925,500, and that's the cost for the 500, I mean 5,500 chips. Yeah. Now we want the general entry that goes from here to there, right? Goes from here to there, right? So what are we gonna do firstly? Do you see this cost of sales amount is high? So you're gonna credit cost of sales with what? 55 million. Yeah, 55,374,500. So basically this minus that. That's what you're gonna um credit cost of sales with. And then we go to inventory. Do you see this inventory amount is lower than this much? So which means inventory we're gonna debit with this amount minus that amount, right? And then revenue, as you can see, there's no revenue here. So we're gonna debit the entire revenue of 65 million. And then let's look at the answer. It should give us the same answer. And then obviously revenue is a profit or loss like item. So, and cost of sales is a profit or loss item. So you are gonna need to do the what do you call this? The deferred tax on it. Yeah. So, so let me just erase this. Okay. Okay, so as you can see, like I said, revenue, debit 65,000. Cost of sales, they did it twice, but if you can say that and that, you'll still get my same answer that I got at 55 million. And then here's their inventory that I told you about. And then the deferred tax. Yeah, the same, like similar to how we've been doing it throughout all along. Okay, so now we are going to the next question. Okay, so the next question. Okay, okay, so what does the next question ask us? The next question says, calculate the profit attributable to the non-controlling interest for the year ended 28 February 2021 as it would appear in Mohale's consolidated financial statements. Like I said, you must always do journal entries with the analysis of equity, right? So analysis of equity must always be there. So when they calculate the profit attributable to Mohale, like I said, this is a complex group, right? So you're gonna start firstly with analyzing the equity of the sub-subsidiary before the subsidiary. So So as you can see, this is the owner's equity of the sub-subsidiary. These are the net assets, goodwill, and then we acquired it this year. So the only since transaction is in the current year. Here is the profit after tax, and obviously it must be only for 2 months because we acquired it 2 months before year end. And then this depreciation is just the depreciation, the additional depreciation from the 250,000, right? Like I said, here will only be the pro forma journal entries here. So this is the deferred tax of it. So this is the um so this is the correction, and then this is the deferred tax for it, right? And then additional amortization, right? Because we have that thing 3 million research cost. So we have to amortize it because it has a finite useful life of 10 years. So that's the amortization from a group level. That's also the pro forma because it wasn't done in both the subsidiary and the parent. And then elimination of like the unrealized profit. So as you can see, this 9,500 comes from exactly this journal entry that we just did here. I'll show you now. As you can see, this amount is a P&L amount, this amount is a P&L amount, so they're going to cancel each other. That's why there was no 65,000 there on this pro forma journal entry, because it's going to cancel each other out. And then here, look at this one is a P&L and this one is an SFP item. Do you see this one is a P&L? That's why it came here. Yeah. Do you see as a minus because it's an expense, it's debited, and then the deferred tax on it. And then here's the current year's profit. This is the profit attributable to the parent. This is the profit attributable to the non-controlling interest, right? So what do? This profit here must also be in the analysis of equity of Kruger, right? Of Kruger. So Kruger, you're gonna start with the net assets. Here's the goodwill of it. Okay, since acquisition. So here is the retained earnings, and then the adjustments to the retained earnings, which is just a normal boiler group. And then we go here, this is the profit after tax. Like I said, this will be the pro forma journal entries, right, on it. So profit on disposal of land, profit on sale of delivery vehicle, right? Because it was all in the current year. And then realization of profit through depreciation. We did these pro forma journal entries before. And then this will give you the profit of Kruger, right? And then this is the profit of intelligence. Like I said, the one that they took there, right? Yeah, the one that they took here, right? And then that profit plus that profit will give you the profit of the current year, right? And then this is the profit attributable to the parent, and this is the profit attributable to the non-controlling interest. Now, the question asked us to do what? Calculate the profit attributable to the non-controlling interest. So, where is the profit attributable to the non-controlling interest? It's this one, right? And what? And and this one. Yeah. So adding those two will give you the um, profit attributable to the non-controlling interest. Next question, it says, calculate the non-controlling interest balance as it will appear in the consolidated financial statements. Even with this one, you use the analysis of equity. Um, let's say the non-controlling interest balance, right? As it will appear, so it will be this. There's the non-controlling interest balance, right? Plus what? Plus this one. That's where they get this 32,416,000. Yeah. So that's basically like a revision of groups, like in a nutshell, small revision. I hope it helped.